For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Investing in shares today can be your gateway to financial freedom. To participate in the stock market, you need to open a CDS and a trading account. Here's a quick guide to help you open these accounts. A CDS account. CDS or Central Depository System account is fully owned and operated by Bursa Malaysia Depository. It keeps a record of the ownership and movement of shares traded on Bursa Malaysia. Simply put, when you buy stocks, shares are credited to your CDS account, and when you sell stocks, they are debited from your CDS account. In addition to a CDS account, you also need to open a trading account with a broker. A trading account is used to place your buy or sell orders in the stock market. Let us show you how to open a CDS account and a trading account in 3 simple steps. Step 1. Access Bursa Malaysia website and choose from any of the licensed stockbrokers listed on the website to open an account. Step 2. Once you have identified your preferred stockbroker, bring along your identity card and your bank documents to the stockbroker's office for verification. Step 3. Look out for a confirmation notice from Bursa Malaysia in your mailbox in the next few days. This mail will provide you with all your account details which you will use every time you trade. If you are new to the market and would like to learn the fundamentals of stock investing, please visit www.bursamarketplace.com. That's it! With these 3 easy steps, you are ready to start investing in the stock market and move towards achieving your financial freedom. Open your CDS account and trading account today. Happy investing!
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia that is titled 5 Stock Investment Principles from Sun Tzu's Art of War. So welcome everybody. Good to see all of you here again on this webinar brought to you by Bursa Malaysia and managed by LifeChamp. So this is the first Bursa webinar for this 2022 and we are very excited to be back again. So today we are going to discuss Sun Tzu's Art of War. What are some of the investing principles that we can extract from these ancient Chinese military treatise? Okay, how many of you here have already have read before or somehow watched some learning videos about Sun Tzu Art of War before? If you have done that, maybe you can click raise the hand button and let us know. If you have done that, you have read that before, you may click raise the hand button and let us know. Okay, wow, quite a handful. Personally, I myself are also a military fans. So I like to read a lot about military warfare. And this Sun Tzu Art of War is ancient Chinese military treatise that talk about strategies used in warfare. So because stock market is similar to like a battlefield, similar to a war, so we can also extract some of the principles, some of the idea, wisdom from this ancient Chinese military treatise. Right. So today we're going to talk about 5 stock investment principles from this book. So disclaimer, as usual. Yes, as usual, this webinar is only for educational purpose. So in no way that we give any recommendation to buy or sell any companies in this webinar. So if you decide to make any investment decision, you are 100% responsible for own risk. Okay. So without further ado, let me introduce our speaker today, and he is none other than Ian Tai. So Ian is the content producer for kclaw.com. Personally, he has written over 100 articles on kclaw.com, and he is also a weekly webinar host and presenter for kclaw.com. He is also a co-founder of dividendvault.com. He manufactured savvy investors who can build dividend-based portfolios independently. And he is a dividend investor. He invests primarily for dividend income, and his yield is ranging between 2 to 8% per annum. He is also an author of 3 books. So this is Ian Tai. So ladies and gentlemen, help me to welcome Ian Tai to our Bursa webinar.
Hey Shane, once again, hey guys, good evening to all of you.
Yeah, good evening.
Once again, I mean to say thank you so much, Shane, for such a wonderful, enthusiastic, welcoming introduction. All right, for this actually webinar session. And yes, actually for this year, I mean, this is actually my first time speaking for Bursa Malaysia, and it's always a pleasure to be here speaking to you guys. And for today's webinar session, I've actually prepared a lot of materials, so let's get right into it. I'm going to just share my screen. Okay. All right, so guys, before I actually get into the stock market stuff, so maybe I can actually just explain or maybe briefly introduce to you guys Sun Tzu's Art of War, how it is used, and the crux of it. All right, so. And personally, I mean to say, I'm a little bit nervous today simply because I may be well versed with stock investing and stuff like that. But then when it comes to Sun Tzu Bing Fa or the Sun Tzu's Art of War, I may be a novice. All right, I may not know everything that I should know about this Chinese treatise or Chinese literature when it comes to military strategy. Okay, so do bear with me if, let's say, I didn't actually interpret it correctly. Let's put it that way. All right. So here we go. So this is actually the brief introduction of Sun Tzu Bing Fa or Sun Tzu's Art of War. Okay. So what I have actually found out is that Sun Tzu's Art of War, right? The author is actually an ancient Chinese military general. So his name was Sun Wu. All right. So Sun Wu is the guy who actually wrote Sun Tzu Bing Fa. So he is actually an ancient Chinese military general. And this piece of work is actually written approximately 500 BC, all right? So which is 500 years before Christ, which means to say, if we figure it out, it could be dated back sometime 2,500 years ago, all right? 2,522 years ago lah. Okay, so that is actually how far it was dated back. And this piece of work, it contains 13 chapters of Chinese classics, and it actually contains philosophies on different aspects of military strategy. And so it is actually my honor and my pleasure to actually be here today to actually share with you guys some of this, a little bit of this military strategies and how we can actually apply this on stock investing. Okay, so of course, when it comes to Sun Tzu Bing Fa, today as we can speak, apart from the Russian-Ukraine war today, typically speaking, there are other applications to Sun Tzu Bing Fa, apart from just war, battle, and military. The applications are as follows. The first one is actually into businesses. All right. So many people say that businesses is like going into battle, So therefore, a lot of people actually, they will read 孙子兵法 and they will get inspired from it. And maybe they can incorporate some of the strategies they have learned in 孙子兵法, and they will actually use it in their business, into management, into leadership, and so on and so forth. Okay, so what I found out is that 孙子兵法, although it's actually a Chinese work, but then it seems surprising to me that it has become a must read among Japanese executives. All right, I'm not too sure whether Chinese executive will read it. Maybe some will read it, but some may not. But for the Japanese, it's a must read. Then the more interesting thing that I found is that, okay, in 2002 we have the World Cup, and Brazil's coach at the time, who is none other than the infamous Scolari. So this Scolari, he was formerly the football coach of Brazil, and he read 孙子兵法, and he was so inspired by it, and he kind of like used some tactics that he learned from this 孙子兵法, and he actually coached Brazil into a winning team, and they won the World Cup in 2002. So I mean to say that it's actually quite fascinating. And last but not least, of course, this presentation, right, I would say, I mean to say I got a lot of help after I read this book. All right, so I would like to give a special appreciation and special appreciation and a shout out to Ko-ai. All right, or for those of you who read Chinese, he is commonly known as Len Yan. All right, and he's the author of this book here, 孙子股票兵法. So I have this book, this copybook here, so I have actually bought it. So why the special appreciation is simply because I mean to say, he is one guy who actually knows how to, who is very passionate about 孙子兵法, and then he's also passionate about stock investing, and he kind of like come up with a Chinese book as shown on the screen, as shown on this camera here. So what he did was he actually explained 孙子兵法, and then he actually kind of like write it in plain Chinese. Because if you ask me to read 孙子兵法, I wouldn't derive anything out of it. So there's this guy who actually interpreted the text, the 孙子兵法 text, and then he actually kind of like translated it into plain simple Chinese. And so that people like me who has limited command of the Chinese language can actually understand what he says and can apply it, can maybe learn a thing or two, or much more than that when it comes to stock investing. So special thanks to Len Yan, special thanks to Ko-ai. All right, thank you so much for coming up with this book. And right now, let's get into the crux of this webinar presentation. So therefore, I would like to present to you the 5 principles from 孙子兵法, or Sun Tzu's Art of War, that we can apply in stock investing today. Okay, so while I read this book over here, all right, I get some inspiration from it. But when it comes to the application, right, it's not totally from him, all right, because the application, how we adapt, how we use the information, right, is actually quite personal, and it is actually an art form by itself. Okay, so what I have done is that I tend to personalize the content and make it useful for my own stock portfolio. Okay, so here's how I'm gonna how do I say conduct this webinar today. So step number 1 is that I'm gonna just read out the original Chinese text, okay, so that you guys will, there's a feel of, I mean to say, so that you guys will know that, hey, it is really from 孙子兵法, all right, so there is an original text. So for those of you who may understand Chinese, maybe that will be a bonus and added advantage. However, I would say that if, let's say today, you are not Chinese literate, okay, then it is actually my pleasure today to actually bring this Chinese classic and introduce it, and to introduce it to you guys, translate it into plain simple English. And I believe there will be another session in Bahasa Malaysia where I'm gonna just translate this text into Bahasa Malaysia, but that is another session. For now, it's English. So I'm gonna just translate the Chinese text into English so that you guys will actually understand what it really means, okay? And that is step number 1. Step number 2 is to expound on the application, okay? So once you know the meaning, then we move into application. So here I will explain how we can actually use it in stock investing. And finally, step number three will be case studies, where I will be presenting some some examples of real life stocks that we can actually apply soon to be far when it comes to stock investing. Okay, so step one is Chinese tax and the explanation, the definition of it. Step number two is about the application. Step number three is about the case study. Okay, so with that, let's move on to principle number one. So I'm going to just read out the Chinese text and it sounds like this, all right? So this is from the chapter where it says positioning, or in Chinese it's called 行军篇, all right? So positioning is like how do you actually position your army, okay? So that is a chapter dedicated for that, positioning. So the principle is as follows. 兵非易多也，魏无武尽，足以兵力，料敌取人而已。Okay, so what on earth is that? What does it mean? So I'm going to just break it down into bits and parts so that we can actually understand and decipher this principle more in-depthly, all right? So the first one is this. So the first text, it says, 兵非易多也. So what does it mean? So here it means that victories are not necessarily secured with the number of soldiers. Okay, so let's say we have two opposing army. All right, so we have country A and country B. Country A has a lot of soldiers. Country B has lesser amount of soldiers. It doesn't mean that country A will automatically secure the victory when it engages in a battle or in a war against country B. Okay, so that is basically what it means. Doesn't mean that you have the size, doesn't mean that you have the population, doesn't mean that you have the number of soldiers, you will win. Okay, so how does that apply in investment? Okay, so here is the application. So we have investor A and we have investor B. So some people think that if investor A has more money than investor B, let's say investor A has $1 million in capital, investor B has $10,000 in capital, ultimately the one that has $1 million in capital will win in the investment game as compared to investor number B, investor B who has lesser amount of capital, which is 10,000 ringgit. So that is not the case. So that is what Sun Zibingfa is talking about, all right? That's what he's recommending. The more capital you have doesn't necessarily mean that you will win the investment game. Okay. Next he actually say, 魏无武尽. Okay, what does it mean? So basically it is directly translated into this text here, which is brawn without brains are pointless in battles, which means, here it means, here's the point here. 武尽 simply refers to brawn, so that is actually investment capital. That means it's the strength of your capital. 魏无 means it's actually referring to the brain, so which talks about the mindset, the plans, the strategies, and the objectives. So if you put them together, it actually kind of like accentuates this point. It is actually all about the importance of having the brains when it comes to stock investing. Okay, so some people actually think that, oh, just because you have $1 million, right, you will ultimately win against the one with 10,000 ringgit. It's actually not the case. All right, so this one is just capital. What is more important than the capital is the mindset. All right, it's the brains of investing, which is the investment mindset, the investment plan, the investment strategy, the objectives, the system. All these things are actually more important. All right, all these things is actually an ingredient to investment success. It is so, that means to say when it comes to investment success, it's not just the capital only. All right, so let's move on. We have this Chinese text here which reads something like this. 足以兵力，料敌取人而已. So 兵力 refers to a focus in core competence, not diversification. 料敌 refers to knowledge of your opponent. 取人 means the art of assessing people or the situation. Okay, so don't get lost here. So let me just break it down one by one. So this text here, what it means is that, okay, When it comes to Ping Li, which is a focus of strength, a focus of core competence, okay? So what it means here is that, let's say, for example, for myself, I'm a dividend investor. So my strength is in identifying fundamentally solid stocks. So what I will do is that I will actually focus on my game plan, on my strength to actually do well in this, to actually do well in this category. All right. So that is called Ping Li. I'm not gonna just diversify. All right. I'm not gonna just say, hey, I'm a dividend guy. Now there's a new stock in town whereby it's actually gonna give super good returns, capital gains. It actually jumps so much in stock price and I should actually follow. So that is actually not the thing that I would do, because it's actually out of my competency. Okay, so therefore I won't actually invest in that stock. So what I will do is that I will not diversify in when it comes to my strategy. I will actually focus on my core competence. Liao Di simply means knowledge on your opponent, which refers to how much do I know about the stock. That is actually very important, because a lot of people, when it comes to stock investing, they do not know what they are buying. So that is actually I would say a pantang larang, which is something which is a no-no when it comes to stock investing. So you got to have an understanding of your opponent, or your understanding of the stock that you're buying into before you actually buy into that stock. All right. And if you know how to do this, then you can actually almost secure a victory when it comes to stock investing. Okay, so that is actually principle number one. Oh, so before that, let me just show you this diagram. Okay, before we move into principle number two, let me just share with you this diagram over here. So as you can see, when it comes to principle one, when it comes to, for most investors, right, what happened is that they believe that just by having capital, just because they have money, they can win in the investment game. Okay. What happened is that they do not have objective, strategy, core competence. They don't have any skill set or core competency and even knowledge when it comes to stocks. Okay. So imagine this. So basically, guys, imagine this. Imagine stock market, right? It's like going into a battlefield. And you today who are listening to me, you guys are the investors. Okay. So investors here are like generals. And then who are our soldiers? Our soldiers are like our capital. Okay. The $10,000 we have, the $100,000 that we have, or the $1 million that we have. These are our soldiers. Okay. So we have the stock market, which is the battlefield. We have us, the investors, who are the generals. And finally, we have the investment capital, which is our soldiers. So what most people do is that they believe that by having a lot of soldiers, they can win. But they forgot about having an objective. They don't have a strategy. They don't have any sort of skills when it comes to leading the army, and they don't have knowledge about their opponent. All right. So that is actually how most people invest, and that is how most people do. That is how most people approach the battlefield. Okay. When it comes to war, all right. That's how most people approach it. No objective, no strategy, no skill, no knowledge. Actually, that is actually a very bad plan to approach. A very bad plan to approach a battle. Okay. But if you are a savvy investor, you should have all these things covered. All right. You should have a clear objective of what you want to do. You should have your strategies crafted out. You should have some skills that protect you from all investment mistakes. And finally, you want to acquire knowledge of your opponent before engaging in a battle. So that is what savvy investors or savvy generals in the stock market do in order to secure victories and to eliminate losses. All right, so let's move on to principle number two. So again, this is actually from the same chapter, which is Xing Jun Pian, which is positioning. And with that, let me just read out to you the text in Chinese, and I will quickly explain to you in plain, simple English. So here we go. So in Chinese, it says, 凡军好高而 二下 ，OK， 贵阳而见阴，养生而处时，均无百疾，是为必胜。All right, so what does it mean in English? So here is the direct translation, the best direct translation that I can think of when it comes to this text. It says, soldiers prefer to camp at high grounds over low places. Soldiers prefer to camp at sunny places over shady ones. This refers to where the general should set his army camp so that his soldiers can be physically and mentally prepared for upcoming battles. Half the battle is won if soldiers are kept fit and healthy. Okay. So that is actually the direct translation. Soldiers prefer to stay on the high ground and they will avoid low places. They like sunny places. They like place which is terang-terang, and places which is quite gelap, they don't like. Okay, so where you set up your army camp is of great importance. Okay, this is because what you want to have is soldiers that are fit and healthy, physically and mentally, so that they can actually secure the victory. Okay, so how do we use this when it comes to investment? The question is this, all right? When it comes to investment, right? Soldiers are like stocks in a way, all right? So the question is, how do you know if a stock is fit and healthy? And the question is, if let's say today you have some experiences in buying stocks, all right, before this webinar, the question is, are the stocks that you buy fit and healthy? So let's say, for example, right now you have a portfolio of 10 stocks. So these are in a way like your soldiers. So the question is, are they fit and healthy? So in order to know whether a soldier or your stock is financially healthy, all right, so what we will do is that we will do a financial health check, just like our body. If let's say we want to know whether a soldier is healthy or not, we will do a body checkup. Likewise, for a stock, we will do a financial checkup. We will do a financial health check for these stocks. So for me, right, it's actually very simple. In order to do the financial health check of a stock, right, here are 4 important questions I will ask when it comes to a stock in order to allow me to quickly assess the health of the financial health of a stock. So these are the 4 questions I will personally ask. All right. So the first one is this: for the last 10 years, did the stock deliver consistent growth in revenues? That is question number 1. Question number 2: for the last 10 years, did the stock deliver consistent growth in shareholders' earnings? That is question number 2. Question number 3: for the last 10 years, did the stock deliver positive cash flow from operations consistently? That is question number 3. And finally, question number 4: over the last 10 years, did the stock maintain low geared and 1.0 and above 1%, sorry, not above 1%, above 1 in current ratio consistently? Okay, so these are the 4 key questions that I will personally ask when it comes to assessing the financial health of a stock. Okay, 4 important questions. And as you can see here, I have actually bolded red over here, the word consistent. All right, so consistency is actually very important when it comes to assessing the financial health of a stock. Okay, because what we want is to generate consistent returns. Like me, I like to generate consistent streams of dividend income, all right, from my stock portfolio. So whenever I invest in a stock, I want to generate consistent growth in dividends, and these dividends are like passive income, and I like them to be consistent. So therefore, when I ask these 4 questions, I'm actually checking one thing is actually very pertinent to me is the consistency of its financial results. Very important. So in order to do that, let me just explain how do I actually assess. Okay, maybe we can actually like communicate. We can actually just interact over here. So I've actually prepared 2 stocks, and from here maybe we can actually see which of these two stocks is actually fit and healthy. Okay, so there's one stock that is not fit and healthy, there's one stock that is fit and healthy. So let's just take a look together. All right, so remember the 4 questions. Let us look together at question number 1, which is, did the stock deliver consistent growth in revenue over the last 10 years? Okay, so this is stock number 1. All right, so as you can see, we have stock A. So this is actually the revenue. And then we have stock B. Okay, so guys, maybe you can actually put in the chat box, which of these 2 stocks do you think is fitter and healthier? So maybe Shane, you can actually monitor the response and let me know.
Sure.
So what did the audience say?
Yeah. So far, everybody say A. Wow.
Okay, very good. So stock A seems to be the one which is fitter and healthier, right? Okay, so that is actually question number 1. So for me, right, personally, what I will do is that I will definitely want to recruit stock A into, I want to enlist stock A into my army lah. All right, let's put it that way. I'll be more than happy to have stock A into my own stock portfolio than stock B. So that is actually question number 1. Now, question number 2. Let's move on to question number 2. Now there are 2 stocks, and the question is this: did the stock deliver consistent growth in earnings for the last 10 years? Okay, so once again, we have 2 stocks. Once again, we have stock A. So this is how it looks like. And we have stock B. Okay, guys, maybe you can put in a chat box, which of the 2 stocks do you think is fit and healthy? It should be a no-brainer. So Shane, any odd replies from our audience today?
So far, all give a no-brainer answer, which is A.
Okay, so far all give answer A. Let me just scroll down. Okay, nobody says B. So that means to say the sanity check of our audience is actually there. All right, so everyone is sane. Thank you so much. Now let's move on to question number 3. Did the stock deliver positive operating cash flows consistently over the last 10 years? Now this is about cash flow. So just now is sales. Second question is profits. The third one is actually about operating cash flow. Once again, we have stock A. This is how the operating cash flow looks like. And this is stock B. All right, guys, maybe you can put in the chat box which of the 2 stocks do you think is fitter and healthier when it comes to its finances?
Yes, everybody say A.
Everybody say A.
Okay.
So it seems that it's a 100% A kind of thing, right? Okay, so that is actually pretty good. Question number 4. Did the stock remain conservatively low geared for the past 10 years? Okay, so we'll just put aside current ratio for now, simply because most of the stocks in Malaysia, right? If let's say the stock has below 1.0 in current ratio, then you may ask yourself why you want to invest in that stock. Especially current ratio, it simply means, for example, let me just explain here before we get into the question. Current ratio is something like this, all right? So let's say, for example, you have a savings account of, let's say, 10,000 ringgit. And then every single month you spend 1,000 ringgit, okay? So let's say, for example, if let's say you do not have any source of income apart from that, what happens is that your 10,000 ringgit can last you for another 10 months. Okay, so that is actually your current ratio. All right. So if let's say the current ratio is above 1, it simply means that the stock has enough financial resources to pay its bills for more than a year. If let's say the current ratio is like 0.2, which means to say the company is in financial trouble, whereby it doesn't have a lot of financial resources to pay its bills. All right. So the higher the current ratio, or at least above 1, is good, because it actually symbolizes, or it actually indicates that the company has enough financial resources to pay its bills over the next 12 months. All right. So therefore, I will just put current ratio aside because most of the stocks in Malaysia tend to have above 1.0 and above in current ratio. So let's just focus on gearing here. So question number 4 is about this. It's about gearing. So let me just read to you the question again, which is, did the stock remain conservatively low geared over the last 10 years? So once again, this is the gearing ratio for stock A. So just look at the chart like this. This is stock A's gearing ratio. And this is stock B's gearing ratio. Okay. So the question is this: which of the two stocks do you think is much better when it comes to financial health? Maybe you can type that, put that in the chat box, and Shane, maybe you can let us know what the audience think.
Almost all A except one say B.
Okay, so this time it's like 95% people, 95.
Sorry, a few say B, not one. 3 say B.
You say B, yeah?
Yeah.
Okay, so typically low geared is actually good, all right? So gearing ratio is like the amount of debt divided by the amount of shareholders' equity times 100%, and that's how you get your gearing ratio. So typically, right, the lesser debt, the less affected they are when it comes to a financial crisis, all right? So stock B's gearing ratio is actually higher, so which means to say it is actually getting more debt, and therefore it is actually more prone to be into financial difficulty if, let's say, it cannot repay its debts. Okay. Now, do know that the stock A and stock B here, these are not fictional. These are not fictional stocks. These are actually real stocks that are listed on Bursa Malaysia. It's just that I conceal their real identity lah. Okay. Because if, let's say, your stock B, then it's not so nice to review who stock B is lah. Let's just put it that way. Okay. So now when it comes to the financial health check, right? If we put the two stocks side by side, stock A and stock B, so I've just asked the 4 questions, right? Over the past 10 years, got consistent growth in revenues or not? Got consistent growth in earnings or not? Got positive operating cash flows or not? And last but not least, is it low and conservatively geared? So for stock A, right, the answer is yes. And for stock B, the answer is no. So what I will do is that I will personally be more prone or more inclined to invest in stock A than to actually invest in stock B. All right. So as you can see over here in this webinar, although the answers that I receive are actually very, very simple. Wow, everybody just say stock A, right? But you will be very surprised to find a lot of people who will not invest in stock A, but yet they will go and buy into stock B. All right.
That's right.
Yep. So guys, sometimes the easy things are people don't do one. So so sometimes the difficult things people will do in the stock market. So what I will say is that we just keep to the simple and the logical, and I think you should do fine in the stock market. All right.
There are some participants who ask, are you able to review what is stock A?
Cannot. Because that is actually not the purpose of not the purpose of the webinar, because I don't want you to say, oh, stock A is a certain stock, and then the next thing you know, you go and buy the stock. So that is actually not the purpose of this webinar. The purpose here is for you to actually have a checklist like this, so that you can actually go and do the assessment yourself on each and every single stock on Bursa Malaysia, so that you can find yourself the right gems that will actually bring you the investment returns when it comes to stock investing. Okay, with that, let's move on to principle number 3. So principle number 3, this is actually from the chapter where it talks about intelligence and espionage. Okay, so this is about spy, all right? This is like the use of James Bond when it comes to war, when it comes to battle, okay? This is about spies, all right? Therefore, in Chinese, it's called 用奸片, all right? Spies. So the question is this: for the author Sun Wu, who wrote Sun Zi Bing Fa, right? He actually placed a lot of importance on getting correct information, getting quality information. to him, the quality of the information is very important because it can really decide the fate of the battle. It can really decide the fate of your soldier. So therefore, the better your information, the better quality your information, the more likelihood that you will survive in the battle. And likewise, when it comes to stock investing, the better quality information you receive, the more likelihood that you are going to survive in the stock market. Okay, so therefore the importance of getting good information. But here's the Chinese text: 先知者不可取于鬼神，不可相与事，不可言与度，知敌知情者也. Okay. All right. So initially, if I read this alone, I wouldn't understand what is it talking about. But fortunately, there's an interpretation of it. And therefore, from the interpretation, I will directly translate it into this text in English. So what it means here is this. It talks about the quality of better information that is being sourced. The sources cannot be from rumors, opinions, or superstitions. Okay? Rumors, opinions, superstitions, guesses, estimates, projections, no. All right? It says here the sources are considered to be reliable if they are obtained from spies. All right? So that means to say you have your spies or your Wotai in Cantonese. All right? You send them across to the opposing army's ground, and then they get the feedback. They have actually how do I say, gather some important information about the opponent or the opposing army. Then they feedback, then they come back and they actually give you some critical information. That is actually what it means. These sources, you can actually assess whether or not they are credible or not. Okay, the better the quality of the information, all right, the more reliable the sources, then you can actually really act upon it. Okay, but why spies? This is because spies, right? Because the information that you can collect from the spies, right? You can actually kind of like verify it through facts and through evidence. Maybe the spies go over there and maybe they kind of like bring back some samples. All right, they go to opposing grounds and then they collect some samples and then they bring it back to their very own commander or general, and from there they can assess the authenticity of the information. Okay, but nevertheless, what it says here is that when it comes to better information, the quality is something to be taken note of. And when it comes to stock investing, likewise, as investors, we have to take notice of where we get our information. Very important. So the question is this: so currently before this webinar, right? Where do you get your sources of stock information? Maybe you can type in the chat box. All right. So let's see where you guys actually where do you guys actually get your information? Perhaps you can actually type in your chat box. Let's say the last stock that you have purchased. Where do you get the sources?
We see newspaper, Bursa announcement, insider news,
insider info,
annual
news,
report, investment banks,
news,
broker, Telegram, Bursa Marketplace, Facebook, chart, KLSC screener, internet news, forum. Yeah, it's common question, common answers.
Okay, so lucky, not kopitiam, not lunch over colleagues, not some blogs, and so on and so forth. Okay, very good, very good. Okay, not Facebook groups, YouTube, WhatsApp groups and stuff like that. Okay, so very good. Now, where you get your information, right? You have to categorize them on, all right? You cannot just simply see that, oh, if let's say you get it from Bursa Malaysia, which is deemed to be very credible, you cannot actually like place, let's say, tips from friends. This kind of tips is more important than the information presented on Bursa Malaysia. All right, you have to have ranks and category of information. All right, you have to filter your information nicely, and then you have to categorize them nicely because it's going to impact your investment decision. Okay. Now, over here, I will just share where I get my sources of information. Okay, so just now I asked the 4 questions. Like, for example, did the stock over the last 10 years deliver consistent growth in sales, profits, positive cash flow, and whether or not it is low geared? Okay, so these are the 4 questions that I want answered first before I buy any stock. So in essence, what I'm trying to do here is to assess the fundamental quality of a stock. So in order to get this kind of information, these are the places, these are the sources of information that I will go and that I'm going to get in order to answer my question. So I will break it down into 4 different categories. The first one is this. All right. When it comes to assessing the fundamental quality of a stock, I break it down into 3 parts: the past, the present, and the future. Okay, so we have fundamental quality. We have 3 parts: the past, the present, and the future. The past represents the past 10 years. The present represents a period of 12 months, which talks about the latest condition of the stock. The third one, which is future, which talks about what the company is going to do, what kind of initiatives are they embarking in order to grow the company. Okay, so it's about the past track record, the present financial strength, and the future growth initiatives. So where do I get the information? So when it comes to the past 10 years, all right, I don't use screeners, I don't read newspapers. I just go ahead and get all this information from the annual reports. Okay, the financial statements that is actually being contained inside the annual report. So that's where I get it. All right. So the first place I will go and do when it comes to assessing the stock's fundamental quality is to read its annual report. When it comes to its present, the present 12 months, what I will do is that I will review the latest 4 quarter of the stock. So that is where I will get the information of the latest condition of the stock. Okay, so we have the past 10 years annual report, we have the latest 4 quarterly reports. And finally, when it comes to future growth plans, these are the places that I will get. Number 1, I will actually read the chairman's statements, the CEO statements, or the management discussion and analysis, which is being presented in the latest annual report of the stock. That's the first place. The second place is that I will look at the quarterly reports, the latest quarterly reports. There's a section called prospects. So that is where I will read to find out the information. The third place is Bursa announcements. So I want to see whether or not they have actually filed in any announcements where it will actually impact the stock. All right. So I just want to see whether or not is there any updates about its growth initiatives before I buy the stock. And last but not least, if let's say I'm interested in the stock, usually they will have a corporate website. So what I will do is that I will visit their corporate website to see whether or not they have actually announced anything. So this will be places where I will be sourcing for information which is related to their future growth plans. So guys, with that said, right, which means to say, when it comes to future growth plans, I don't actually speculate. I don't actually make guesses like, oh, the stock is going to do this or that. Oh, the stock is going to make certain amount of profits because of this or that. So I don't make such educated guesses. Rather, I will simply just go to all these places as mentioned, the latest annual report, the latest quarterly report, Bursa announcements, and corporate websites in order to find credible and reliable sources of information so that I can actually assess the stock much better. Okay. And last but not least, when it comes to stock valuation, so in order to calculate the valuation ratio of the stock, I need the stock price. So what I will do is that, yes, you can actually go to Bursa Malaysia to find the stock price. But alternatively, if you want it to be convenient, you can actually go and use Yahoo Finance or Google Finance to obtain the stock price to calculate the necessary financial or the necessary valuation ratios like PE ratio, PB ratio, and dividend yields. All right. So these are the places. Now, once again, we have this slide where I will demonstrate, okay, how do we actually look at information when it comes to stock investing. Now, for most investors today, some people actually, they do this, all right? Maybe they say, yeah, Ian, you know, reading annual reports are very lengthy, very troublesome, very cumbersome, you know, it takes some time to actually read annual reports. So when I hear people say that, what happens is that when it comes to making decisions in stocks, right, maybe they tend to actually rely on what they have conversed in a kopitiam, or maybe they will watch Facebook gurus or YouTube. They will actually view stock gurus who talk about predictions, estimations, what might happen in the stock market in Facebook or YouTube. Maybe they will find them entertaining and maybe they will make their decisions from there. Why? Because that is actually the source of information they are getting when it comes to stocks. All right. So they find it entertaining enough to watch. So therefore they will buy and sell stocks based on that over annual reports and quarterly reports. Of course, some people will just want to have brokers reports from various investment banks. Maybe there's a target price they set, and maybe they will actually base on that. Some people may use e-newspapers, or some people may just simply, you know, read blogs, read all kinds of websites, and then from there they kind of like figure out themselves whether or not this information are good enough to actually help them to make good investment decisions. But apparently most of the time, right, I don't actually rely on that. All right. And I find that for me, for most of my friends who are into stock investing, right, we tend not to actually rely on that kind of information to make investment decisions. Okay, because they are not exactly the sources of information. We kind of like do not put a lot of weightage. We do not like place them as of great importance when it comes to deciding on stock investments. Rather, when it comes to stock investing, right, what we will do is that we will base it on facts and data. So when it comes to facts and data, right, what we want is documentation, actual documentation of the financial records of the stock itself. So therefore, the places that I personally believe that is credible and reliable will be the ones stated on the slide, like annual reports, quarterly reports, Bursa website, and corporate website. So these are the places I will source for my information. Okay. So guys, here's the thing. When it comes to information, two things that you need to actually understand. Number one, there's a classification or category of information. You have to know which one is important and which one is not important. And number two, when it comes to stock investing, I would recommend, I would personally, if you're a value investor, you may want to actually look into factual-based, data-based information over opinion-based information. Okay. So with that, let's move on to the next principle, which is a very good principle over here. So this one is actually about calculations, a chapter on calculations. So this is actually about risk and reward and stuff like that. So in Chinese, it's called 实际篇, right? And this one is relatively short, so I'm just gonna quickly just read the Chinese text over here. It says 利而诱之，乱而取之. Okay, so there are two parts. 利而诱之，乱而取之. Let's start off with the 利而诱之. All right, what does it mean? 利而诱之 simply means beware of decoy or traps. Okay, so 利 here simply means benefit. 诱 here simply means traps. So a lot of people, what they do is that typically, especially when it comes to better, right? There are some people who are greedy, some people who wanted quick success. So what they do is that they will tend to fall into traps. Okay, so for Sun Tzu Bing Fa, what it says here is that beware of these traps. Do not, you know, do not try to be overly ambitious. Do not try to be greedy. All right. Do away with that, because if you invest with a very greedy kind of mindset, or you wanted quick success, you tend to actually fall into traps, fall into decoys. So that is basically what it means. Okay. Now, here are some symptoms of greed that I typically observe when it comes to stock investing. Okay. So the first one is this. So some people, they view stock investing as a place to make quick money. So basically, the reason why they buy is that is because that they think that this is a place where they can get a lot of capital gains, and not just a lot of capital gains, but they can actually make fast capital gains or trading gains from stock investing. All right, so this is actually a game of greed. So beware of this kind of emotions when it comes to investing, and so that is actually the first one. So basically, there are two symptoms of greed. The first one is actually people who are attracted to price increase, all right, because they want fast and a lot of capital gains. That's the first one. Okay. The second one is actually more subtle, all right, more subtle kind of greed. In fact, this one is actually the one that I committed, all right, which is value traps. Okay, so basically for me, I started off as a value investor, as a dividend guy. So when I was a rookie, right, what I would do is that I would just try to aim for the highest amount of dividends, all right? So I tend to place that as great importance. So which means to say, if I'm given two stocks today, stock A and stock B, stock A is giving me 8% dividends. Stock B is giving me 5% dividends, all right? However, stock A that is giving me 8% dividends, the fundamental strength is not strong. Stock B, who is giving me 5% dividends, the fundamental strength is really strong. So in the past, what I will do is this: I will buy stock A. Why? Because I tend to say that, hey, you know what? The one that is giving me 8% is of a better deal than stock A, which is giving me lesser dividend yields. So that is actually a form of greed. And that has actually caused me to actually stumble upon value traps. Okay, so guys, don't commit what I have done. Today, if you ask me stock A or stock B, I would say I would probably pick stock B, where the fundamental strength is stronger than stock A, although the dividend yield is actually much lower than stock A, right? So remember, there are two symptoms of greed. The one that is trying to get fast capital gains, and the second one will be one who actually falls into value traps. Okay, so example one. Okay, let's do some case study over here. So this is actually Google Finance. So what I've done is that I have actually copy and paste the stock price here. So the question is this. So the question is, you see here, people who actually bought Top Glove at $10 or $20. So the question is this: why do you think that people buy Top Glove at $10 or $20 a share? Maybe you can actually type in the chat box and let us know. All right. So the question is, why do you think that people tend to buy Top Glove when it is actually rising at $10 or $20? What is the psychology behind this? Do people actually read the financial reports of this company before they actually buy the stock? What is the valuation like when they buy the stock at $10, $15, or $20? Maybe Shane, you can actually expound some of the responses from our audience.
Okay, mainly FOMO, fear of missing out, greed, trend following, chasing the market, expecting price to go up again, And Maslan said, trying to save the world.
You said the goal,
That's
huh?
interesting.
Yep.
Rumors that it can go up to 40 ringgit.
Oh, hey, Casey Lau is also in. Okay, okay. Hello, boss. All right. So maybe it's another Casey Lau. I don't know, but okay. So I mean to say, if all right, so good response. All right. So basically, a lot of people they tend to say greed, FOMO, sky no limit, greedy. So these are actually emotions that are very real and they are very apparent in the stock market. So we have to be aware of it. So that's actually example number one. Now, this is example number two. So the question is this. From, let's say before the bonus issue, it used to trade at close to $28, $30. Now after bonus issue, it should be around $8, $9. From $8, $9, it actually dropped to now $2. So it seems that Top Glove has actually fallen by close to 70 or 80% from its peak. So the question is this, guys. Does it mean that Top Glove is now 70% or 80% more undervalued? What do you think, guys? Maybe you can type in the chat box. So what do you think? Is Top Glove now really 80% undervalued? So Shane, what do you
Not
think?
necessarily is the common answer.
Not necessarily is the common answer, yeah? Okay, so good. All right, so thank you so much for your response. Now let's move on to the next question. This seems to be a famous stock. Actually, for investors, right, we don't really care about this company, all right, because I mean to say, usually our radar, right, if you understand from value investors' point of view, right, we tend to actually ask the 4 questions. Over the last 10 years, got consistent growth in sales or not? Got consistent growth in profits or not? Got cash flow or not? Low gear or not? And all this kind of stuff. So usually our radar, our mind is actually more fixated to stocks that have this kind of characteristics. So when it comes to other stocks that don't, right, we tend not to know one, all right? But this one is basically, after I do not know, maybe after a quick chat with some friends who may not be so well versed in stock investing, they started to talk about this. Then I just look at the Google Finance, and this is actually what I have covered. So now the question is this: people who wanted to buy Serba Dynamic, what do you think, guys? Are these people here truly investing? Are these people here interested to hold on to this stock for the long term or for life? So what do you think are the reasons for people who are interested to buy Serba Dynamic at 35 cents? Maybe you guys can actually voice your opinion. All right, so a lot of people says capital gains, speculate. All right. Are there anyone who says this is actually undervalued? Anyone who says this is undervalued or discount? Maybe you can actually put in
Yeah.
yes.
Iqbal say discount.
Discount. Betting that it will turn
Speculate.
around. High risk, high gain. All right. So there are actually people who bought 2 lots at 30 cents. So all right. So there are people who do that. So maybe for you who actually do that, so you may want to assess, because I don't know, all right? Because usually we don't actually focus on, we only focus on the good ones, okay? So now the question is, what is the psychology behind purchasing this stock? So that is actually more of a lesson than to tell you whether or not you should buy more or you should get rid of this stock, all right? So that's not the purpose of this particular webinar, all right? Now, let's play a game. Okay, so this one, I'm gonna throw you a very tough one. Okay, maybe Shane, you can actually do a poll, and let's see your response, all right? I'm actually very interested to know how you respond to this question. Okay, so the question is this. Is this a value buy or a value trap? So now we have Tenaga Nasional on the 23rd of February, which is last month. The stock price of Tenaga was trading at 9.02. Okay. So it has actually dropped from $16 in 2019 or so. Okay. So I checked the dividends, right? Over the last 12 months, it kind of like paid out 80 cents lah in total dividends, including special dividends. So if you say 80 cents in dividends per share, you divide it by 9.02, you will get a dividend yield of 8.9% per annum. So the question is this a value buy or is this a value trap? All right, guys, I'm going to give you 20 seconds or 30 seconds to actually decide, and maybe you can cast a vote and see and I would like to see your response from there. All right. So Shane, what do you think?
There have been more than 150 responses already. So let's wait. You give them 20 seconds, right? Let's wait another 10 seconds.
Yeah. Of course, if you want to, after you have actually cast your vote, you want to say something more, then perhaps you can actually you can actually put in the chat box and see whether or not this is actually truly a buy or is this truly a value trap or is this truly a value buy? All right, let's see a response. So Shane, are we ready to close the poll? And
okay, at your command anytime, sir.
Okay, 5, 4, 3, 2, 1, end the poll. Let's see the response. So
okay, let me share the result.
Yeah, share the result. Wow, so it seems that 64% of you guys are saying that this is definitely a value buy, and there are 73 of you guys who say this is actually a value trap. So 64% says yes, it's a value buy. 36% says it's a value trap. Unfortunately for me and both Shane, we cannot give you the answer because that is actually not the purpose of the webinar. All right, but instead, let me just answer this question indirectly with another example. Okay. So over here, let me just move on to the next part of the principle, which is 乱而取之. So this is actually tied up to the Tenaga example, whether Tenaga is actually a value buy or a value trap. So we have to understand what is 乱而取之. 乱而取之 simply means it is about capitalizing upon chaos. All right. So in the midst of chaos, how do we actually profit from it? So this includes, and chaos times includes, heightening of market fears and uncertainties. Okay, so this is about capitalizing on chaos. Now, the question is this. All right, how many of you actually bought Public Bank? Okay, so this is actually after the bonus issue. But let's recall back 2 years ago, like 2020, like 2020. How many of you guys actually bought Public Bank at a price below 15 ringgit a share? So remember in 2020 that we have a lockdown and then everyone is actually like feeling there's a market fear, the market's gonna crash, there's a lot of fears about our economy, there's so much uncertainties going on. How many of you actually bought Public Bank at a price below 15? Maybe you can actually put in the chat box. Below 15. Wow, so many of you actually bought into Public Bank below 15. And Wong says you bought Maybank. Okay, that's good. All right. So some of you may have Sapu and BB instead. Okay, so all right. So thank you so much for your response. So the question is why? All right. Why did some people actually buy Public Bank at below $15? I can't actually answer for all, but from a value investing perspective, all right, maybe we can actually get some clues as to why public bank, okay? Why below 15 at that time? So the first thing that we need to see is this, the investor, but the first thing we need to see is the investor. And more importantly, we have to look at the motive, all right? So what is the investor thinking? What is his motive when it comes to investing in the stock market? So the question is this, all right? Maybe this is a question posed to yourself. The question is, are you interested in short-term trading, or are you interested in long-term business ownership? Okay, so which means to say, after you buy the stock, how long you want to hold on to it? Do you just want to hold on to it for a few months or maybe 1 or 2 years? Just wait for the stock price to go up and then you sell? Are you that kind of person? Or are you the kind that says, okay, after I buy at a discount, I'll probably hold on to the stock for life? Okay, so that is actually motive. So let's say, for example, these people, public bank, people who buy public bank at below 15, they are people who are interested to hold on to the stock over the long term. So the answer is long-term business ownership. So let's say we go according to this logic, all right? We will actually not say that, we will actually say that these people are more into long-term business ownership over short-term trades, okay? So that's the motive. Now let's check the financial results of public bank. So as you can see, I have taken out the annual reports of public bank, and I have actually plotted a graph of its shareholders' earnings. So remember just now we talked about the financial health check. So this is actually question number 2, whereby did public bank actually deliver consistent growth in earnings over the last 10 years? So over here, we can see that I believe the answer is yes. Okay, so most fundamental investors, right, or most value investors will look at the annual reports, they'll plot a graph like this and they say, yes, it actually fulfills this criteria. Very good, fundamental strength is there. Then only we move on to the next, one, which is stock valuation. Okay, so now when it comes to stock valuation, what I will do is that typically for me, all right, I will calculate PE ratio and dividend yields. So over the last 10 years, right, what I figure out is that when it comes to PE ratio, its 10-year low, all right, the 10-year represents a period from 2010 to 2019. So the lowest PE at that time is 13.45. The average is 14.9, and the highest is 17.15. So what does it mean? What it means here is that for fundamental investors, for value investors like myself, we will want to buy a stock when the PE ratio is at its lowest, and we will avoid buying the stock when it is trading at its highest PE ratio. Okay, and we believe that the fair valuation should be around 14.9. Okay, so that is basically what it means. So we will tend to buy the stock when it is trading at its lowest, all right, which is around 13. 15 is about fair, and 17 is a bit high. Okay, so that is actually what it means. We tend to buy it when it's undervalued, and we tend not to buy it when it is overvalued. So let's say, for example, public bank at that time is trading at $15 a share, $15 per share. So based on this PE ratio, what I've calculated is that the PE ratio at the time at 15 ringgit a share in 2020, all right, its current PE ratio is 10.56, which is below its lowest, which is 13.45. So in this sense, the stock valuation at that time is actually the lowest in the past 10 years. So for fundamental investors at that time, they will see that this deal is undervalued based on PE ratio. Now let's move on to dividend yields. Now, when it comes to dividend yields, we also have the lowest, the average, and the highest. So what we will do is that as an investor, we tend to buy the stock if the dividend yield offered is actually closer to its highest, which is 3.76. We believe that 3% is kind of like fair. And if let's say Public Bank is offering 2%, and that is actually the lowest, then we'll say the deal is actually not too good. All right. So what we will do is that we will want to buy Public Bank if it's offering above 3% in dividend yield. But at that time in 2020, when Public Bank was trading at around 15 ringgit a share, based on its last year's dividends per share of 73 cents, we find that its current dividend yield at that time was 4.87%. So since 4.87% is the highest, therefore, once again, it shows that it is actually the most undervalued. So therefore, as a fundamental investor, we check three things, okay? Number one, the motive. The motive is to own Public Bank for the long term. We are not here to trade. We want to actually acquire the business, and we want to own it for life. That's number one, check the motive. Number two, we'll check the fundamentals. So fundamentals will go through the four questions, but apparently for Public Bank, we cut it short. We just look at the profits, and it says that yes, it has actually delivered consistent growth in profits over the last 10 years. So that's very good. And last but not least, we check the stock valuation, and the stock valuation makes sense. And because of that, it kind of like makes sense for investors to buy into Public Bank when it was trading below $15. Okay, so that is actually the case. Now, these are the three steps, right? It seems very simple, right? So what I've just said just now, you can actually use it on Tenaga. Okay, so you go through the first one, which is the motive. Do you want to own Tenaga for life? Question number two, how's the 10-year financial results like? Did it generate consistent growth in sales, profits, and operating cash flow for the past 10 years? Plot a graph like what I've just done, and let the graph tell you the fundamentals of Tenaga. Okay, that one will be your homework. And last but not least, you can actually, if let's say Tenaga is fundamentally strong, then you can do the stock valuation like this, and from there you can actually see whether or not this thing actually works. Okay, so I think I've run quite a fair bit of time, so let's move on to principle number 5, which is this. Okay, so this is actually about variation of tactics, or 九变篇. And in the Chinese text, original Chinese text, it is as follows: 徒有所不由，君有所不及，臣有所不公，地有所不争，君命有所不收。So what does it mean? In direct translation, it says, some paths are not to be journeyed upon, some battles are not to be engaged, some cities are not to be taken down, some lands are not to be conquered, and last but not least, some orders are not to be carried out. So let me just give you a quick example before we end this webinar session. Let's say, for example, I'm a dividend investor. Now, let's say, for example, I'm a dividend investor, and my plan is to build a dividend portfolio for retirement. I'm looking to invest in fundamentally solid stocks, and I intend to hold on to these stocks for the long term. And let's say I'm expecting at least 4% per annum in dividend yields. So that's my plan. That's my objective. And that's my strategy to build wealth when it comes to stock investing. Situation 1. So the question is this. And let's say you follow me, all right? Let's say you have the same idea like me, all right? You have the same plan, you have the same strategy. So situation number 1. So one day your friend comes to you and say that he is using technical analysis tools and charting softwares to trade, and out of it, right, he actually made 100% or 200% in trading gains from his recent stock trade, which seems to be a lot faster than getting 4% dividend yields per annum. So the question is this: should you follow and do stock trading? Type in the chat box. All right, so what do you think? A lot of people say no, but there's one who say yes. All right, some say yes. Okay, so most people actually say no. Some people say partially. All right. So basically, right, if you ask me, right, if my plan is to invest for dividends and I'm trying to get my 4% dividend yields, and my plan is to invest in the fundamentally solid stocks, typically I won't actually, just because I won't actually change my strategy. Even though my friend has mentioned that using technical analysis software, using technical tools or charting software can actually get him a lot higher returns from his stock trades than my 4%. All right. Some things in the stock market, if it's not yours, it's not yours. All right. Let's put it that way. Now, let's move on to situation number 2. Now, the next day, you have lunch with your colleagues. And one of these colleagues, right, they are so excited about a tech stock. And the reason why they are excited is simply because the tech stock is on the rise. And it seems that after the discussion, you also think that it could go a lot higher than its current stock price. So the question is this: should you or should I buy the tech stock? What do you think, guys? All right, so many of you guys say no, some of you say yes, not acting as immediately, study first. All right, so really good response. Okay, now let's move on to the third one, third situation. So let's say you are a dividend investor, and then the very next day, after work, you took your shower and then you start to read some blogs, and then you read a blog post of an investor who wrote in favor of a specific Internet of Things industry, IoT industry. So this guy, he actually invested a couple of stocks in the industry, and you studied them and you found that these stocks that he purchased, right, they are loss making at the moment, but you also kind of like found out that they seem to have very good potential. It seems like it's the next thing. All right, 5G, big data, AI, but they are loss making at the moment. So the question is this: should you buy these stocks? What do you think? Yes, no, don't know, right? So now the stock is, so now it's actually kind of like a mixture already. All right. So based on Sun Tzu Bing Fa, what we say here. Okay. So this is actually what it means. Some paths are not to be journeyed upon. Some battles are not to be engaged. Some cities are not to be taken down. Some lands are not to be conquered upon. Some orders are not to be carried out. So according to Sun Tzu Bing Fa, what it simply means is this: if you have a game plan, you stick to it. All right. If you have a game plan, you stick to it. You don't try to do too many things. You don't try to trade. Suddenly you start off as a dividend guy, and then suddenly you go and trade. Or you are a dividend guy, then suddenly, just because some stocks have actually risen like 20, 50 or 200%, you go and chase the stock. Just because some investor has a different opinion than yours, you go and follow his opinion and you go and buy that stock. It's not going to work that way. When it comes to investing, it's best that you have your own game plan and you stick to it. All right. So that is actually the point here that is being brought out by Sun Tzu Bing Fa. All right, guys. So I think I've gone overboard, but here are the 5 principles that I would like to leave it to you guys. So here are the 5 principles. Number 1, doesn't mean that you have a lot of capital. It will guarantee investment success. All right. So this talks about the importance of having an investment plan. Number 2, all right, it's all about the financial health of a stock. So just like a general who will actually assess the location of the place before he actually sets up the camp, so that he can make sure that his soldiers are healthy. What we want to do when it comes to our portfolio is that we want to include all the fundamentally solid stocks into our portfolio. Principle number three is that we always have to be mindful about the quality and the credibility of the information of the stock. That's a classification, so please be aware of that. Number four, beware of decoys. Don't invest because of greed. Capitalize upon chaos. All right. And there's a Tenaga National Berhad for you to do. So that's your homework. And last but not least, stick to your own game plan. Don't deviate from it. All right. So these are the 5 principles. And with that, thank you so much. I think I've gone a bit over time, and my tongue twisted quite a lot today. But
Yeah,
anyway,
thank you very much.
Shane, back to you.
Thank you, Ian. So that is the 5 stock principles that we can learn from Sun Tzu's Art of War. Thank you so much, Ian, for delivering it so wonderfully. So next, you have any questions for Ian, please write in the Q&A. So we only have 5 minutes for Q&A. So of course, we can't answer any investment advice related questions, whether this stock can buy or not, that stock can buy or not. So we are unable to answer any of these questions. So you ask other related questions, okay? So Janice would like to ask, does defining objective mean knowing when to withdraw shares?
Yes, you can say that lah. I mean to say, if let's say your plan is to invest in certain kind of stock, right? And let's say previously you have some other stocks that you have bought because of whatever so reasons lah. Okay. So once you have actually have a new perspective, you have a new objective of what you want to do. So it's time for you to get rid of the stocks that don't fit into your objective, and you will actually include stocks that will fit into your objective. So the answer is yes.
Okay, thank you so much, Ian. So must we do 10 years financial check? Can it be shorter? This question is by Jennifer.
I would prefer to do a 10 years simply because in 10 years, anything can happen. All right. Political leadership can change. Economic uncertainties are there. We have the US trade war. You have the US-China trade war. Now we have the Russian-Ukraine war, and then we have COVID-19. Everything can happen in 10 years. So the reason why 10 years is because I want to see in that 10 years, in that 10 years period, right, when so many things happen, right, the stock can still deliver consistent growth in profits. So to me, 3 to 5 years is not good enough. 10 years is good.
Yeah, 10 years. What you mean is 10 years is long enough to test whether this company can withstand the economy uncertainty or the recession period or not.
Correct.
All right. The next question is, just now you mentioned about search for quality information. So the question here is, annual report has so many pages. So which part should we focus on?
The first part is this okay. Remember the 4 questions: the delivery of consistent growth of sales, profits, operating cash flow, and gearing, right? So the first thing is that if you want a shortcut, the first place is to go to the financial statements. The 10-year financial, you have 10 reports, right? Every report will have 2 years of reporting. So which means to say, if you download 2021's annual report, you should have 2020 and 2021's financial results, right? So just download 5, get all the data, and then from there you will know already whether you want to continue to do your study on this stock or whether you want to avoid investing into this stock altogether. All right. So that's the shortcut way lah.
Christopher would like to ask, would you recommend dollar cost averaging or timing the market when it comes to buying a dividend stocks?
Okay, I won't say I won't use dollar cost averaging. I mean to say I like consistent investing. Okay. And but I won't say dollar cost because I don't buy stocks when the price is actually overvalued. So what I will do is that I will consistently save, all right, as much as I can. And at that time, I will find the best value of stock and then I will invest. So let's say in January, let's say I find that stock A is offering the best value, then I will probably put some money on stock A. Then a few months later, I won't just simply buy onto stock A just because it increased. I'll find another value stock and I'll put into stock B and so on and so forth. So it's more like value cost averaging than dollar cost averaging. I don't just buy a stock just because the time for me to buy is supposed to be there. it's not the case. I will do the valuation before buying the stock. Yeah.
All right, thank you so much, Ian. So it looks like we have come to the end of this session. So thank you everybody for staying until the end of this session. So give me a minute. Let me tell you more about our next webinar.